Good evening. Here is your in-depth financial and geopolitical briefing. Global markets closed Friday with silver priced at $83, following volatility linked to the latest PCE inflation data. As trading concluded on the COMEX for the week, attention shifted beyond New York and Chicago to Paris, France. Curious. There, senior United States trade negotiators are meeting directly with officials from the Chinese Communist Party. The purpose of these discussions is to map out the agenda for an upcoming presidential summit expected within the next 30 to 60 days. According to the report, this is not described as a routine diplomatic courtesy. Instead, it is presented as a high-stakes negotiation involving trade policy, energy security, sovereign debt dynamics, and access to strategic commodities. The article argues that while financial headlines focus on short-term price moves, broader structural decisions may be taking shape behind closed doors in Paris. It frames the meeting as potentially consequential for the direction of the US dollar, global commodity flows, and industrial metals markets, including silver. The report connects the recent movement in silver prices to these geopolitical developments. It notes that Friday's close at $83 occurred just as formal U.S. futures trading paused for the weekend. However, it emphasizes that international discussions continue and that developments from Paris could intersect with market reopening in Asia, particularly when the Shanghai Gold Exchange resumes trading Sunday night Eastern Time. The article then outlines what it describes as a challenging negotiating position for the United States. It cites an authorization by the US Treasury Department issued days before the summit, approving the purchase of 19 million barrels of sanctioned Russian oil. This move follows 2 years of strong public messaging surrounding sanctions against Russia and claims of American energy independence. The stated rationale, according to the report, is concern that heating oil prices in the Northeast are approaching $5 per gallon. The article asserts that policymakers are wary of the political consequences if winter energy costs continue to rise. In addition to energy concerns, the report references the deaths of 4 American service members in a drone strike in the Middle East. It states that the administration's response has centered on diplomatic engagement and closed-door negotiations rather than immediate escalation. The article attributes this approach to concerns about fiscal strain, political repercussions, and inflationary risks associated with expanded military operations. It further suggests that during the Paris talks, U.S. officials may be seeking cooperation from China on Middle East stability, particularly as it relates to oil supply continuity and broader market confidence. The report then shifts to China's economic position. It states that China recently announced a $214 billion trade surplus, the largest in more than a decade. This surplus reflects exports exceeding imports by that amount. Historically, according to the article, surplus dollars were often recycled into U.S. Treasury securities, reinforcing the dollar-based financial system. However, the report claims that China is increasingly redirecting capital into physical commodities instead of long-term U.S. debt. Specifically, it cites gold, copper, rare earth elements, and industrial silver as areas of accumulation. The article links this strategy to expanding global demand for electric vehicles, solar panels, 5G infrastructure, and semiconductor production. It provides detailed figures stating that global silver mine output stands at approximately 850 million ounces per year, while projected industrial demand could exceed 1.2 billion ounces annually by 2028. That would create a potential annual deficit of 350 million ounces, which would need to be met through above-ground stockpiles or investor liquidation. The article asserts that significant investor liquidation has not materialized and instead describes continued retail and institutional accumulation. Within this framework, it suggests that Chinese negotiators in Paris may be pursuing long-term access to strategic commodities, including silver production and refining capacity. It frames these potential discussions as part of a broader economic realignment in which physical assets are prioritized over sovereign debt instruments. Expanding further, the report situates the Paris summit within a larger global monetary context. It states that members of the BRICS bloc, China, Russia, India, Brazil, and South Africa, are increasing trade settlements in national currencies and building systems that reduce reliance on the US dollar. The article presents this as part of an ongoing shift in international finance, with some countries seeking alternatives to dollar-denominated reserves and treasury holdings. Timing is also emphasized. While U.S. futures markets closed Friday with silver at $83, Asian markets, including the Shanghai Gold Exchange, reopened Sunday night Eastern Time. The report suggests that any signals emerging from the Paris discussions could influence early week price action in metals markets, particularly if commodity access or financial cooperation is addressed during negotiations. In summary, the article portrays the Paris meeting as a pivotal event linking energy policy, Middle East stability, sovereign debt dynamics, and global commodity strategy. It ties together the U.S. authorization to purchase 19 million barrels of sanctioned Russian oil, the reported $214 billion Chinese trade surplus, projected silver supply deficits, and the broader shift toward physical commodities. According to the report, these elements collectively frame a moment of potential transition in trade relationships and financial flows. As international negotiations continue through the weekend and markets prepare to reopen in Asia, investors and policymakers alike will be watching closely for any indication of how discussions in Paris may influence global economic dynamics. We will continue to follow developments and provide updates as new information becomes available.